Hello, my name is Dr. George Machaki, and welcome to Finance 225, International Finance Management. You're taking this course at Harper College. You're taking me in an online class or a face-to-face class. This is a supplement to our lectures in a face-to-face class and discussion board within our online class. So, again, you've printed out my concept maps. They're in a PDF file, 2 pages, and they're at the second tier. You will add on to the second tier. You look at the author. The book is an excellent reading book. Gives you a lot of examples for each of the concepts we'll be talking today about capital budgeting. We'll be talking about taxes, other factors that affect capital budgeting at the subsidiary. And remember, the whole thing that we're looking at this from this financials from the MMC perspective is to always make the MMC, the parent, the main MMC of added value, even though it may add value works well for the subsidiary, but hopefully it plays in part of the strategical plan, financial plan for strategy that the MNC has that it brings value into the parent MMC. Otherwise, it's not a good plan. It won't be a good capital improvement project. All right, so we're going to talk about that. So let's say, so remember, you print them out, and this is summarization. You can't get everything out of here. Just found me on YouTube. It'll give you some general idea about it. I'll give you some concepts, but you have to sign up for the course. Ask for Dr. Machaki. Ask for Finance 225. Ask what other classes I'm teaching. I'm trying to pay off my student loans, so I teach as a contractor for several colleges, and that's what keeps me going. All right, so make sure you sign up. There's no way you can get a general idea, but you're never going to really understand the concepts of capital budgeting unless you read the material, read the book. And like I said, this is a summarization. Just going to give you a quick overview at the end, and then you say it makes sense or not. Or you look at my concept maps. I'll give you more of the tiers and what did I miss when I took the notes when I was reading. Remember, when you're reading, use the concept maps and add on to it. Okay, so let's get going here. I try to been keeping them underneath an hour. I've been doing pretty good. I'm not going into much detail on some of the math problems. Remember, you're going to have math problems. We'll discuss those in the classroom and do them on there. But on the exams, it's all just going to be conceptuals, concepts, and vocabulary. I want you to understand that as a good basics. And then, as but you'll still do some math. But I don't want to freak you out for the exams. There's just way too much information. All right, so let's look at the web. You're going to go into the web, look at the web. Remember, I got the links, of course, Blackboard Management System at Harper. Or you also could look at this YouTube, full YouTube, if you look at Harper University iTunes U. You go in there, you're myself or other instructors to teach a class, so you may not like the way I'm presenting it to me, another instructor. So now I get it from his or her perspective. Remember, we're all unique. We all have different learning styles, and we all look at finance and looking at math. You have to understand it in here. I can't just tell you and you're going to know it like that. You have to take it and conceptualize it within your mind. Once you see it in your vision and your mind, then it all makes sense. Okay, so the first one here is country-specific information, general business rules, and tax environment. So what we're going to be talking about, we're talking about capital budgeting. In capital budgeting, there's some requirements. Which currency denomination am I using when I'm bringing it in? How I'm going to pay for it, what's the tax breaks, what's the incentives, what's the inflation rates going in there, will I get remember, I'm looking at the dollars or the currency that I'm utilizing to utilize it to its maximum effectiveness and efficiency. Okay, so let's click on this one. So it tells me about different taxes. So just send in for information. It tells you about global business, country debt, governments, regulations, growth. It has information and services, audited assurance. So it does other things, but it also gives you about different industries, power utilities. So you find information on here in general business rules for that industry as a whole and general tax environment. So when I'm looking at capital budgeting, I'm opening up what are the rules, what makes sense. Should I open up that project at that subsidiary? Especially if I got other countries that are bidding for the same asset for me to open up my facilities, either direct investment or something in that country. They're trying to enhance me because remember, it'll help their economic status of that region that I'm opening up, because they'll hire people, they get taxed. There's a lot of other things we're going to be talking about. Okay, that's a nice site. Remember, always open up, look at them, save the sites always. Remember, because even though if you're saving them in Blackboard, after so long, Blackboard's turned off. So I would have a file and I'd save all these international financing sites. So when you need them, you don't have to look up. They're credible sites to already be out there. Or if this is the degree you're going into corporate finance or finance as a whole, I wouldn't sell the book. I'd keep the book. It's a good a reference book. As you know, tied this with your corporate finance book that you had, and because you have a lot of the formulas there, they just bring it over into this international finance, figuring you already understand the elements, and it's the same way I'm looking at it. But it gives you a good foundation. How you learn the material is how it'll come back to you when you have to study it or try to retrieve it later. All right, so you have that one, so we'll turn that off. The next one here is worldwidetax.com, and that one here is another site. You could go in here. Let's see if I get it up. Okay, so now it has different things. It tells you about different countries, and look, it gives you a lot about different countries. So if I want to open up, let's say Russia. What's the tax Russia? All right, so they got Russia, population, currency, business hours, international dialing, business practices, travel, inflation rates, Russia GDP, unemployment rate. What's the unemployment rate of Russia? Not too bad, similar to ours. All right. Right, so there's a lot of information you could get onto these sites. I'm not trying to tell you, just click that one. You could find something else, state tax rates, get free us, Russia income taxes. Let's see how they tax. Income taxes, 15% on the dividend income. So federal tax is 2%. It's not too bad. Regional tax is 8%. Maximum tax profit is 20%. So when I'm looking at the tax, I think ours are running around like 33%. So it's not too bad doing in Russia. But what else do you have to do? What is the government regulation? Or the same thing with China. We can look at China, see what their taxes are in China. All right. But I'll let that up for you to look at the countries. Remember, these are good sites for references when you're going to be doing the multinational corporation project you're doing for this course. All right. So you had to come up with some site. Here's something. Why did you select this country? Here's a good tax rate versus some other countries that I was looking at. It. So you can't just say I'm going to Russia. I looked at Russia. I looked at Poland. I look at some of the countries in that hemisphere and see which ones make sense and which one gives me the best tax breaks and could I work with the government. All right. So you have that one. We took that off. And the other one here is Yahoo Finance. And again, Yahoo Finance. Again, it tells you stuff about this one here. I forget what I did this one. This one did with the stocks and some of the other examples that I have in here. So I threw it in here. Look at it, and again, it's got a lot of information, and it's in simplistic words. It's easy for you to understand. It's an everyday language. It's using the regular business, net present value and everything else, but it explains it a little more into detail for the average individual to understand. Once you understand that, it's not that hard. Same thing when I do some of the other YouTubes I give you, especially I give the one NBA BS, and I like utilizing his site because it's right to the point, very simplistic. That's why he says it's not that complicated. Just the verbiage is harder. Okay. Well, it's just different verbiage, different words. Remember, once I know what the word means and I can visualize in my mind, that's all a word is, or a math. It just symbolically lets me know what's going on. Okay, so let's look at subsidiary versus parent perspective. We're still looking at it from the MCM perspective. We're going to chapter 14 and everything else. So now we're looking at the subsidiary. How are they visualizing it? So that within the subsidiary, within the MMC, the parent, I have subsidiaries. Maybe one, or if one country makes it easier, I understand that. But if I have several countries, which countries are better than others for my capital improvement? Or sometimes I might have no chance. It may not be cost-wise, might not be there, but because of government regulations and revenue and tariffs, you know what I mean, or quotas that they're putting on me, I open up because the dollars or the currency or the profit will still be there. I just have to go around it a little different ways. Okay, so let's look at the subsidiary versus parent perspective. Okay, now tax differentials. Let me make this just a little bit bigger for you guys and gals. 200. All right. Now, remember, read along. You already read it. You've looked at it. The author's got excellent examples. Stop, look at it. For a lot of the math problems, he'll walk you right through it. I'm just going to skim through it just so you look at the charts, but he'll explain them. He explains it very well. So what I'm trying to do is make sure you take the course, sign up for the course, and everyone benefits. Okay. So different tax rates may make a project feasible or not from a subsidiary perspective, but is it? But not from the parent's perspective. You know, I made too much money, but I'm making too much money overall. I want to have more of a tax break, so it may not be it. I'm just saying, think of the strategy, just outright, just a question. If you get a question, the tax rates are good for the subsidiary, but remember, your whole thing, the whole strategy of MMC is to bring value to the corporate, to the parent MMC. Okay, restrictions and remitted currency, the money they got to bring back. Governments place restrictions on whether earnings must remain in the country. You have to remain them for so long, and they have some examples. Some of you have to remain it after you make the profit 2 years, 3 years, whatever it is, before I can start shifting it out. But that's fine. If I'm making it there, it's still a profit thing. Eventually, I'll get it on. I just have to make sure that I maximize the usage of that currency when it's contained or restricted for a certain period before I could yank it out. Okay, excessive remittances. The parent company faces fees to the subsidiary. A project may appear favorable from the parent perspective, but not from the subsidiary perspective. So when I'm looking at that, the parent's making money, but from a subsidiary, it's hurting their profit line, or let's look at it this way: it's breaking it even. As a subsidiary, I always want to make more profits, so they don't sell me. So I am a cash cow for the MMC. Okay, exchange rate movement. Now look at exchange rate movements. Earnings converted to currencies, or the parent company when I'm bringing it back. After I paid everything else off, when I decide to bring the money back to show my stockholders that I'm making my profitability, I'm bringing it back in, will be affected by exchange rate movements. Okay. Now, summary of exchange rate movements, and I have this one here. Okay, parent's perspective. Let me just go this. I've got the summary here. It'll just walk you through cash flows, corporate taxes paid, after taxes, when the money's coming. It's just easy to follow through on this. You're adults, you're at college. I don't have to read it. You can just freeze me. I'm trying to go on here, but it says, okay, parent's perspective. Appropriate when evaluating the project. Since the parent shareholders are the owners, you have to remember that. Project's general sufficient cash flow to the parent. Remember, I got to make sufficient, at least break even, because sometimes my strategy may just be expansion into other markets. So I may not be making as much money as I want at that time because I'm learning the market, but I don't want to be losing too long. Stockholders hate that. Okay, enhance shareholders' wealth. This is what I'm going to say. The future will enhance. One exception, we got the warning, is that when foreign subsidiary, okay, one exception is when the foreign subsidiary is not wholly owned by the parent. So in a better, when you read this, what it's going to say, I have a foreign subsidiary, and we're in a merger, or we're doing just an alliance or a partnership. So it's financed between two of us. So I don't have the full control of it. So basically, I have to split the profitability. Okay, or retain earnings of the parent to subsidiary. So this is just a little more. Before I get to cash, how do I split it up, and which makes sense for both parties once I'm cashing it in to get looking at it as my profits after taxes. Okay, all right, that took care of that. The next one we're going to talk about is input for multinational capital budgeting. Okay, and we have a lot here. Okay, so if I'm looking at input for multinational capital budget, what kind of information do I need before I decide where I'm going to place my capital budgeting dollars? And I'm just assuming a multinational corporation has several subsidiaries in different countries, just for this chapter, just to go through. So you could do some comparison, because what I'll do later on, we have a budgeting example, and we're going to walk through the way the author does it. You'll have a budgeting example, and you'll have the math portion and the analysis that you would look at different years, and you as a team within the classroom will start looking at as a team and trying to develop some kind of a conclusion, and then we'll finish this, and then as you look at the other thing, we'll look at different factors. I will add on the inflation rate, I'll add on other things. What if you had this information? Remember, same thing in finance, anything else, when I'm doing anything in the future, the more information I have, the higher probability that that outcome will be the way I want it. The problem is we a lot of times don't have all the information, or the information we have to make some assumptions or modify the information to fit into our model, for lack of better words, or theory, different template that we're trying to find out certain aspects. Okay, like the spot rate. What does the spot rate do? What are my premiums? Some of the forward contracts that are out there, some of the information that I may have historical, but it may not. How do I make sure that it has the same parameters in that time frame or that environment in that time period that we've been talking about? The environment a little different, you have a little different outcome. Same thing like, look at if you're baking something, put everything else, you got to just turn the temperature up a little bit higher, either overbaked or underbaked, or something, or it's not baked in the middle, or it has to be just right. So that's why when you're looking at it for that profitability, everything else got to be just right. But what is it different? Remember, a lot of this stuff that you're learning here, there's software there that does it for you, but you still have to input the data into the software so it could come up with a conclusion. All right, you still make the decision, but this gives you it gives you kind of a general direction. It gives you a little more factual information that you can make a logical use logical assumptions and come up with a logical conclusion. Okay, MMC, and I'll read most of this because some people do like, I'll read it out. I have people that have some disabilities that may have visual disabilities, so I have to read it out in this classroom so you have it. But even if you're taking this and you're putting this on your MP3 player and you're driving to work, you want to listen to me on that work, so at least you have it. Okay, MMC will normally require forecasts of financials that influence initial investments or cash flows of the project. Remember, cash flows in or cash flows out. I have to have some kind of a projection, some forecast. Where's the money coming? How much it's going to cost me? Will I have it in the right denomination at the right time that's needed? Okay, so I marked this down to 8 steps, kind of the 8 things you should be looking at. Initial investment. Funds initially, the definition, initially invested included whatever is necessary to start the project, additional funds, working capital, support the project over time. This is my initial investment. What do I need to start the project? I need this much. I need all this other funds later on, but this gives me the core. So this is my initial investment to get going. All right. Price and consumer demand. This is what I sell through, that the stockholders say that's a good idea, even though I know there's going to be some overrun. But even the overrun, what percent do you think I'm going to be overrun from? I try to hit the main dollar goal for my capital investment, but I know maybe it'll go up 10%. The closer I get to that dollar, the better financial planner I am. Okay, price and consumer demand. Okay, so price and consumer demand, which are uncertain. I'm building a facility there, anticipating that the consumer demand is going up. So remember, even in finance, I have to be in contact with my marketing, my statisticians, to make sure what is the trend. I'm building this thing in here. Will the consumers be wanting that product? So there's a lot of different scenarios other than the finance. Finance, I'm just giving you the money. Yeah, that's a good idea. But somebody else got to say it's a good idea because in China, 1.5 billion Chinese, and their economy, their standard of living is going up. They're going to want more of my goods. All right. Okay. So what's going on? I have to understand that aspect in the capital budgeting aspect when I'm coming up there. There's a lot. There's the logistics. That's why you have to have manufacturing, sales, marketing. Everyone is involved in a capital budget project. Not that I build it and you try to sell it and there's no customers out there who can't afford it. Okay, now the costs. You have 2 types of costs you learn from accounting. Variable costs can be developed from comparative costs of the components. No easy. I can always kind of figure out once I got it. And your fixed costs. Fixed costs can be estimated without an estimate of consumer demand. Hey, what's the fixed cost? I'm going to put the building here. It's going to cost me so much for taxes, so much for maintenance, so much. That's my fixed cost. It doesn't change. And my variable cost, my electricity may go up and down, but overall the rates are fairly stable. Okay, so those are there. The other cost, the variable cost, the cost of goods, other things could change, but the fixed costs, I could kind of come up with some assumptions looking at buildings or projects similar, whether it's my own or somebody else's, to see how close they came up to their actual. Okay. Okay, now tax laws. Now these are kind of international tax effects. Remember when we had accounting, they had the new international accounting procedure, so everyone's looking at the same. You're looking at apples with apples and orange and oranges. You're not doing a conversion. A lot of countries are buying into that. Within the next 5, 10 years, every country's going to have it, and it'll make it so much easier when I'm looking at the tax. Even though the tax laws may be different, but how I depreciate it or how I show it up on my bottom line should be consistent. You know, I mean, just a number. Look at the tax laws here. Let's look at that. The federal tax is the same, but if I look at the state taxes, you know, so like if we looked at Russia, they call it regional taxes. Okay, so look at the state taxes here. They're different. Illinois is one of the highest. I hate to say it. Wisconsin was higher, it was lower. So where do I want to open up a play? Which one has a better tax break? But okay, so here's my tax. It may be higher here, but Illinois gives me all this free water, gives me this land, gives me everything else. Hey, after a while, shit, I'm making more money here, even with the higher tax rate, because all the other deductions that I could take, or the other incentives, direct or indirect, that we've talked about, I could utilize. And so for the next 10 years, this is a good product. And who knows, you know, 10 years, I want it forever. Nothing's forever. I could sell the product, the building's enough, it's, you know, salvage value or something in there if I want. Okay, so now I've got that, so it's tax laws, remitted funds, MSC policy for bringing funds back or expending funds. The parent influences estimated cash flows. What time? Is it quarterly or is it by the market when it's the best time to bring it back and forth? Sometimes I have to pay my own bills. I have to show my own quarterly report, so I have to bring it in. Do I bring it in or do I pass or you know, it depends what my strategy is. It depends what I want to show up as my you know, to my stockholders or to investors. And sometimes it's Wall Street that's directing it. Oh, you're not making enough money, so now I'm doing the offensive instead of being on the defensive. Okay. Okay, so exchange rates, we've talked about that. Very difficult to forecast. Exchange rate depends on the company. But, you know, certain countries you're working at are very stable. The U.S. is very stable. It goes up and down, not too bad. China is a little flexible because of devaluation. All right, but some of the other, Brazil's, its inflation's up to things, unrest, everything else. You want to impeach the president there. Hey, who the heck knows what the exchange rate? The money's already used here, so maybe I don't want their cash, their currencies, but maybe I could do something with a bartering, so you know, equivalent. I don't want the cash. Give me so much oil. Give me so much whatever resources I'm looking for. Okay, now salvage, liquidation value, success of the project, attitude holds towards the project. Okay, so I'm looking at liquidation after the project's done, or when I'm finished with the project. What is the how much could I salvage or depreciate or write off, or what could I give back, or what could I do if I have to liquidate? Let's leave it at that. Okay. Okay. Now rate of return. MSC should first estimate its cost of the capital, derive its rate of return on the project. So here's how much capital is cost. Here are how much my rate of return on the project based on the risk of that project. So if I'm looking at there's a formula in there, and we'll talk about a little bit in there. You're plugging in numbers, and then you could see which project has a higher rate of return depending on the risk. Remember, the higher the risk, the higher the rate of return, but the higher it could default, I could lose. And that may be something, you know, sometimes when you have extra money and you figure, hey, if I take a loss, I can still go right off as a loss. If I make a profit, I'll look good, but I could get a better return on my investment, or I could get a better return if the business goes under from a tax perspective. Okay? All right, so we have that. Now let's look at it. Here's an example of the problem. I'm going to go this, and this I'm just talking in the class. We already had it, so we'll talk about it. But just in case some people are reading this ahead, the background was basically, oh, just let me close all this all off, okay? His Spartan company, there's one that we were following along, is considering developing a subsidiary in Singapore that would manufacture and sell tennis rackets locally, only in Singapore. That's all they're doing it. That doesn't make sense. Well, there's other ones. Let's do Singapore. There seems to be a mark for whatever reason. Okay, I'm not looking at that. This is what you're looking at. So this is the scenario. Boom. Just like you're going to do your own scenario for your MMC for the paper you're going to be doing as a team. What's the scenario? Why do you want to open up that? I'm not questioning you. I'm just saying, okay, if that's what you think, now you're just going to sell me the dollar amount that makes sense. Forget the conceptual amount. I figure you already sold me that if you come to me at this time. Okay, financial managers have to ask finance how it's going to cost, marketing is the potential, and manufacturing how it's going to affect the process, provide the input for capital requirements. All this is a needed necessity as part of the total cost that we talked about earlier up in here. Remember when I'm looking at my costs, my fixed costs, okay? Now, provide information. Okay, additional information that I'm going to need. We'll meet with the government officials in Singapore to discuss proposed subsidiary. The project will end in 4 years. So to tell them, here's how long the project. We're going to want so much. We're going to have a tax break in here. We're going to employ so many people. After that, here's what's going to happen with the project. Either we're done, it's a one-time deal, or we're going to be sustainable in here and we'll hire a lesser amount of people. But here's what it's going to provide back into the GDP. Remember, I'm talking to the government from a business. Why are you giving me the break? Because in the long term, I already made the commitment. Everything else works well. Your population, your marketing wants this. Everybody wants this. And what kind of deal I'm making? I'm making a deal here. I'm finding it. Revenue information. Okay, so if I'm looking at revenue information, initial investments, 20 million. You know, that's in Singapore dollars. Okay. Price of consumer demand, here's how the prices, 350, 360. So there is a price increase. It's an estimate. Remember, you don't know, but this is to say, hey, we could, it'll go up in prices and we could sell more once we get the name recognition. Our variable costs, you see how it's changing. Okay, years 1 and 2, years 3 to 250, and so it's going up, pretty good. Looking at maybe like a 10%, 5% inflation rate. Okay, fixed rate, 2 million stays across there. Tax is 20% income tax. Hey, not too bad. That's why I want to open up in Singapore. Lower it in the U.S., make it here. All right. Get some benefits. Remitted funds, 10% withholding tax on remitted funds. So they're going to tax me the money I'm coming bringing back. So I have to that's part of my yield, how much I have to pay. Okay, exchange spot rate is 0.50 cents for Singapore dollar, not bad. Salvage value is 12 million out of my project. That was what I want to say was 20 million in here someplace. Information. Here it is, 20 million, so I could still salvage, not too bad. Okay, rate of return 15%. And remember, some companies may have a rate of return of 5%, 10, 15% is a modest rate of return. I get a higher rate of return, that's fine, but either I have a lot of information, or I have a stable market, or I'm taking a lot more risk. Okay, so now you're going to have some analysis, capital budget analysis conducted from a parent's perspective. You're looking at not from the a subsidiary. The subsidiary is already giving you the numbers. This is why we think it's going. It's a good idea. Okay, now I have to take their numbers and see what's going to do to the whole MMC parent. Will it add value or bring value? And the value could be not only for the capital project, it may bring me more customer base. It may bring me overall value. Remember, value of the MCM, not only the dollar amount, it could be name recognition, it could be expansion. And so now I'm expanding, so that gives me more confidence into the stockholders that want to invest in this. Okay, so assumption would be wholly owned by the parent, so you don't have any partnership in here. Create enhanced value of the parent. Determine whether Spartan and corporate should establish a subsidiary. And here you have the information, 1, 2, 3 years. And I would look at this numbers here. This is giving me the numbers. Here's what's going to happen. What's my cash flow? Okay, what's my present value of 15% cash flow? Which one is going down in year 2? Remember Singapore? Went down, went back up again. Then it shot up very nicely in year 4. So am I looking at a 4-year initial investment by the parent is 10,000, 10 million, sorry, and then cumulative net present value. Which one is the best one? I don't start making anything else in my cumulative net value until my 4th year. So I have to understand that. But see, it's telling me how much is going. Not too bad. Could I understand? Remember, this is just I'm making my assumption. Should the project go? That's all I'm looking at that. Okay, calculation for net present value. Here's just a formula, and they have that in here. And like I said, there's an example in the book. I'm not going through this. The example in the book, walk you step and step. It's the only way you're going to learn it. I could tell you 20 times to read it 50-50, unless you look at it and say, here's step one, here's step two, here's a net present value, plus 10, here's a summation, here's the time, cash flow, so, salvage value, 1 plus K, what do I have here? K, required rate of return for the project, N is my lifetime. Are you okay? I'm just kidding, you guys. You guys are doing great. Remember, you should be aware of the formulas you're looking at here. Here's the numbers. See, here's what happens. A lot of times you have the numbers. Somebody's created a number. So you're at this position. You're looking at these numbers here. Here's all your information. What could I do? Because it's going to affect the cash flow, not only the subsidiary, but the parent. I got a project going in here. So now that cash is no longer available until that project is doing it because I have to fund it. And I can't start a project and not having it. So a lot of projects to start, and they're hoping for additional finances, and the economy goes down, and they're stuck. It's stuck there. And and they're stuck in a position where you don't have enough to at least make it halfway workable, or down, plan Z that at least gives me the shell and rent some money on it. It just stays there. But even if it's non-productive, I may be losing money, but it could be a benefit to the overall dollar amount for the subsidiary. I'm not making a profit. Sometimes I'm not making a profit. I'm not making as much. But overall, I'm stable. I'm not losing money. I'm doing fine. Okay, results of Spiriton problem. Parent and net present value. This is after. So they went out here. Here's my result. Net present value ended up with 200, 2,229 and 867. Okay. Because the net present value is positive, the project spec, the discount rate is 15%, has fully accounted for the project's risk. If the analysis has not yet accounted for the risk. Okay, so if I'm looking at this, so it's about 2 million bucks, so it's not too bad. All right. So where did I come? I came up right in here. All right. So Spartan may decide to reject the project, and that's perfectly well what they could do on that. Okay. And in this case, they're gone. Now remember, so you have that. So what's going to happen? Now we're going to go on. Let me move in here. We finished this one. Just close this off. Now we're going to move along, and I'm going to come up here, other factors to consider. Now, in here, I'm going to have the rate fluctuations. In this case, when you did the scenario, and we came up with the present value, net present value, 2 billion out here. Now look at this, and we're going to go on. What if I had this information? Now I had this information. The exchange rate. Other things I have to consider. This would be real quick and dirty. Now, what about the exchange rate? I provide three different scenarios. Okay, so here's the exchange rate. Here's the net present value. So as the exchange rate has, cumulative net present value, does it have something on here that looks over the year? Strong Singapore dollar, present value of cash flow. So it's given me everything else was happy with the exchange rate. We're going to do by remittance. Okay, and this one here is strong, so it's telling you the value of Singapore dollar, sensitivity of the project to the net present value, to the different exchange rates. Okay, give me some information. All right, and now difficult to forecast. Remember exchange rates, we've talked about that. Multiple capital budget analysis. Here's another one. Incorporate other scenarios for exchange rate movements. I'm taking this. Remember, I've got that. It looks good. Let's see what happens if these change. I'm just assuming, let's say the exchange rate is constant. But let's say, but something's going, some turmoil is happening, and the country I have, the exchange rate is, there has some turmoil. It's volatile. You know what I mean? So, but I have historical, so I'm kind of making some assumptions. But let's say it's kind of stable, for lack of a better word. Incorporate other scenarios for the Presto scenario and the scenario you like. So you're looking at that. Which is the better scenario if this happens? So you're making some determination. Exchange rate tied to the parent currencies. MMCs consider projects in other currencies where the local currency is tied to the dollar. Remember, it depends what the currency, if it's tied to the dollar, so it has a different strategy I have to look at. Okay, hedge on the exchange rate. Always hedging. Remember, we're hedging. Because it's unpredictable, but I want to make sure I know it, so I have the different hedging. Okay, so what am I looking at here? May hedge expected cash flow of a new project, should evaluate the project based on the hedge exchange rate. And here's some exchange rates for the same thing. So now if I would have looked at the same project we're doing, remember, and now I have this on here, so look how the numbers have changed. In year four, dropped down considerably, right? Analysis when a portion of expected cash flow ahead. And the hedging is I'm just protecting in case it didn't make it to there. So how do I, if it went the wrong way, I'm always protected. So remember, I want to make a profit, a nice profit. I want to make an abundable profit. I can't always do that. So, but I want to make sure that at least I make my 15%, my return on my investment, okay, my present value. What do I want? I want at least in there, so I have to hedge to make sure in case something doesn't go. It's like an insurance policy I'm paying now. Okay? All right, so we've taken care of that. Ooh, geez, we did a lot here. Pretty good, huh? Okay, so that took care of the factors. Okay, so that's right. Let's go to now the inflation. Should affect both costs and revenue. Sorry, I didn't finish it. Exchange rate of highly inflated countries tend to weaken over time. Okay, joint impact. Inflation, exchange rate fluctuation. So keep them together because usually they're tied fairly close. Remember, the exchange rate and the inflation rate, or the consumer price index. So it kind of gives me a good indicator. Maybe partially offset effect from the viewpoint of a parent. Now, financing arrangements. Example of a call out. Let's do a call out. Okay, and a call out means example you have in the book. So I'm just reading this out there, just cutting it the verbatim and throwing it up on here. Assume a subsidiary borrows Singapore 10 million to purchase previously leased offices. Subsidiary make an interest payment on this loan of 1 million Singapore dollars annually. Will pay the principal of 10 million Singapore dollars at the end of year four at termination. Okay, coming in here and paying them back. Singapore government permits a maximum of $2 million per year in depreciation for this project. Okay, the subsidiary depreciates rate will remain unchanged from your accounting. Assume the offices are expected to be sold at 10 million after taxes year end. Okay, so that's my call out, and the answer is the annual cash flow outflows for the subsidiary are still the same. Nothing changes. The subsidiary must pay the 10 million Singapore dollars in loan principals at the end of the 4 years. However, since it receives Singapore $10 million from sales of the office, it can use the proceed of the sale to pay off the loan principal. So it worked out well. Okay? Okay, parent financing, other factors to consider in this question. Okay, let me turn off the call outs and the answers. Okay, here's another one, so I'll just turn these off here. Here's a question. I try to throw that in. Uh, Remember, the book has it, and we'll talk in the class. Just as a reminder, instead of the subsidiary question, subsidiary is financing. Okay, so instead of parent doing the financing, the subsidiary is going to be doing. Instead of subsidiary leasing or purchasing would borrow funds, the parent uses its own funds. I'm sorry, the other way around. The parent uses its own funds to purchase the offices. Its initial investment is 15 million, composed of original 10 million investment, plus an additional 5 million to obtain additional extra 10 million Singapore dollars to purchase the office through the exchange rate. So here's my answer. The subsidiary will not have any loan or lease payments. The parent's initial investment is 15 million instead of 10. The salvage value to receive by a parent is 22 million instead of 12. Big difference, remember, because I'm paying it there, not doing any money. Because the offices are assumed to be sold at 10 million after 4 years. So they do better in this. It doesn't in a scenario. Doesn't make sense. What if you don't have a cash? Do I want to go into debt? Do I want to spend my money? What's the environment there? Do I want to take a loan? All these are questions that you have to depend. What's going to give the value of the parent MMC to make the stockholders happy? Okay, so we took care of that one. Okay. Parent financing others. Okay, we did this one. Comparison of parent and financing things. I think I had in here. Revised examples show that the increased investments by the parent increases the exchange rate exposure. This one here. Okay, for the following reason. One, parent provides the entire investment. No foreign no foreign financing is required. Consequently, subsidy makes no interest payments and therefore remits larger cash flows to the payments. I don't have to pay anything out there, no kind of interest or anything else. I just pay the full amount back. Okay? So I don't have to, it's not part of my expense. It'll come back on. So no interest payments, therefore remits larger cash flows. But then you have to look at how much is they're charging me. How much could I remit and then what in the time frame. Okay? Okay, two. Salvage value to be remitted to the parent is larger. We went from, remember, if it was there because of the subsidiary, I loaned, it was only, I got back 12, and here I got back 22 million. Okay? Giving larger payments to the parent, that's what I want, to take care of the parent. Maybe good for the subsidiary there, but I'm always looking at the parent. Always looking at the parent. That your job is to take care of the corporate. The other things are just branches that make the corporation strong. That's what they do with the MMC. International by parents are more susceptible. Okay, Exhibit 6, analysis alternatives. So this is just basically looking at the dollars amount. So if you have that, here's my demand. I'm looking at that cash flow. I still didn't do too well. Didn't do too bad at year 4. Solid value, remember? Alternate financing. So now when you look at this, you can look at these different tables that we have, and that's how you'd be looking at it, right? You'd be looking at different tables that we looked at here, and then you're going to evaluate this, okay? So I'm going through a lot, and it's easier now with the book that you could have it, you could follow it. Okay, let's look at block funds. Again, block funds exhibit. Here are funds that are blocked. Accommodated by reinvestment funds to be remitted, withholding after taxes, salvage value. So you have it by different years. Okay, you have it remitted by the subsidiary to the funds that they can't have it when it comes in here. All right. Now the host countries may block. Okay, the host countries may block funds that the subsidiary attempts to send back. So I have to look at it. So if they're going to be blocking too much funds, I may just do the subsidiary there because I don't want that. I can't take that much back. I'm better off utilizing the money in Singapore and expanding out that way within their region that I may have depending on the market condition in the relationship that that country has or that I have there with other countries around there. How I would, whether I keep the funds in there, because then I have a smaller amount coming back. Remember, you have to look at that. That's part of the other things that you're looking at, and there's always a dollar amount attached to that. Okay, some countries require earnings generated by subsidies to be reinvested locally for 3 years, so I can't take nothing out before they can remit it back. So that's something to think about. Remember, but that may be a good advantage. If it's growing economy, what's the difference? Making money there. And remember, the rules and the laws could always change, or I have a way of bringing it back out of this country, or converting the money into a product or something selling there and coming around the other way. Let's be realistic on this. There's other ways to come around. Okay, solid value. Significant input on the project's net present value. Consider scenario analysis to estimate the net present value and the various salvage value. And we went through that a little bit. Break even salvage value, considering estimating at zero the net present value. Just do it. Just another way to look at the salvage. At the break even, here's zero. We're done. Break even salvage value equation. You have that in here. Okay. And there's an example in the book that walks through it, real easy, simple. And look, it's just fine print. That's the only thing that bothers me when I read the book. It's so fine, and I got glasses. Those of you got the electronic version, you can make it a little larger. But for the book, that's why it looks like it's hard because there's a lot of information trying to keep the pages down. So how do I keep the pages down? So you don't pay more for the book. It's the cost. So make the print smaller, give you more information, and the overall book is the cost, the material of the book is less. But if the ebook eliminates all that, because I could get the links right away. I'm getting used to it, and I'm older. I like the ebooks. I can make it larger. I need my glasses, easy to read. Okay. Okay, but anyway, so my whole thing, I got off track here, is look at the book. It has the example, walks it step by step. If anything else, Xerox, copy it, make it larger, you can see it. Okay, impact of project on prevailing cash flow. Again, you've got the information. It's just carrying up the whole project in the Spartan, preventing cash flow for Spartan. So now you've seen one project and you're walking it through. Look at this, and here's the next one. If sales volume apparent increases following the establishment of the project, that's favorable. If the existing cash flow decline following establishment of the project, looking at the value, will be unfavorable. And then again, I'm looking at the government incentives. Remember, I'm trying to do a capital investment, direct foreign investment in that facility. There's a plant, whatever I'm building in there. What do I get from the government? Low rate host government loans. Hey, I'll keep it in there. It's cheaper, right? Even though I can't take it out there, but I'm making money on that. Remember, you have to look at a lot of companies and multinationals are not looking at the short term. The U.S. we're looking at the short term because Wall Street says you're not making a profit, so they're selling off, and then they're not looking at the long term. A lot of multinational organizations are looking at the long term, 5 to 10 years. So here's my strategy. I'm coming in here, I'm losing money, making Samsung when it came into the market here wasn't a big name, little. Now Samsung is a hard, large brand to to if you reckon with, for lack of better words. Okay, it is a good brand, but it started off people said, "What the heck, Samsung?" Another Japanese or Korean or Japanese or Chinese didn't know. Now they know Samsung's a very good, solid brand, but they started off small, but they had a long-term strategy. And a lot of MCMs are looking long-term, 4 or 5 years. We're making money, but they're not making money. But then you have to look: is the domain going to be there after that? Okay. Okay, so host countries reduce tax rates, the government subsidizes the initial investment. Hey, how could I go wrong? Okay, depends on the government, and you have to look at the government. Is it going to be in power in 2 weeks, if or 2 years? In the Middle East, there's a lot of governments that are going back and forth, so you're a little more wary. Maybe that's where you want the government to invest. Hey, what do I got to lose? To lose is their money, all right? I pull out. But if they make it, I'm all right. And so I may have an option to buy it from them after so long. Okay, real option values, opportunity to obtain limited real asset probability that the real option will be exercised. Net present value will result in an exercise in the real option. Okay, so we took care of that. Those are my other factors. Now, adjusting the assessment of risk. We have a few things. Risk adjustment discount. Let's see a premium. The greater the uncertainty about the project's forecasted cash flows, the larger should be the discounted rate applied to the cash flow. It's just I got a larger risk, so I don't mind it. So I got a higher return. But if something happens, hopefully more at the end of the project, I've got most of my money already recouped or already making some profit, so it's not too bad. I'm more worried about the front end when I start making the money coming in. Like in this project, there's what happens when in the first 2 3 years and belly goes worse than my estimates, and now it says, okay, you won't be making any kind of you won't be in the red or in the black or in the positive until 2 more years. So I'm going to look at worst case scenario. If this happens here, could we sustain it for 2 years where the stock goes and say, hey, you're reducing the value of the MMC. Okay, sensitivity analysis, more useful than simple point estimates because it reassesses that's a tongue twister. The project based on various circumstances may occur. Software again doing it. Simulation is using a variety of task generation, probability distribution of net present value based on a range of possible values for one or more input of the variables. Typically is an aided software. There's no way you're going to do all the variables. Trust me. That's why when I'm looking at the math in the class here, I'm showing you the math, giving you a formula, but everything else is going to be doing a spreadsheet or in the software. I plug in the numbers, put it in there, and I understand what the relationship, what's it telling me, and I can go forward. But you still have to understand what's the numbers. If I got a calculator of 2 plus 2, I put it in there. I don't know, there's 2 items coming in there, 2 units makes 4. Just a number. What does it mean? Okay, so we've got that. So we're done on that. Okay, hey, doing pretty good. Let's look at the summary. Now, the summary in this chapter, and we're almost done. I think hopefully I'm within an hour. I'm really trying for our class. Remember, most of you already have me. I've slowed down a little on here talking. but we have it. So we cover basically the three: capital budgeting, risks of international projects, and multinational capital budgeting. So when I'm looking at this, may generate different results and different conclusions depending whether it's conducted from the perspective of MMC or conducted from the subsidiary. So it's perspective from MMC, I'm looking at the parent. Always a parent, it's always in relationship converted to dollars, not from the from the perspective of the subsidiary, but from the MMC. It could be too. It depends what you're looking at. Sometimes it may not be a big issue. You may want to say something starting off because let's look at that from the subsidiary now, but down the road, because it's so small, it's getting larger, and there's more capital investment or more money invested into this project, then it will have an effect, either positive or negative, on the total value of the parent MMC, multinational corporation. Okay, MMC, parent is deciding to implement international product, determine on whether the project is feasible from its own perspective, always looking from the MMC. Okay, risk management on here, so let's look at this one first. Risks of international projects can be accounted for by adjusting the discount rate. Okay, used to estimate the project net present value. Those two are correlation. Okay, and note adjustment of discount rate is subjective, so I'm kind of making my best guess. Remember, when I'm looking at subjective, it's me looking at all the different factors I have. They're looking at what the software is telling me and my intuitive gut feeling. Those who are good financial managers, their gut feeling tells them this is the way to go. Sometimes you could be wrong. If you ate something wrong, you got that gut feeling. But majority of the time, they know. They tried. The numbers are telling them that they just say, "Here it is. I just know it." And if they don't know it, the business out of business. If they do know it, they're doing well. Okay. Now, alternative method on this one is estimate the net present value instead of using discount rate, based on the various possible scenarios we talked about for exchange rate or other uncertain factors. Use the sensitivity analysis or simulation. And so I'm making those adjustments and see what happens. If you make too many hypotheticals, you're going to lose it. It's going to be just too complicated. Look at the main ones that you think is going to happen. What if the moon starts out? There's an asteroid coming here. It could wipe out everything else. But, you're looking at the doomsday theory. It could happen. I'm not saying, be prepared. Keep everything else in check. I'm good with God and everybody else. I'm good with my bankers. I'm good with everybody. Okay. It's gonna. Some people say, "Oh, it's doomsday," and they don't pay their bills or anything else. Go. But I'm just saying, those things gonna happen. Rationally, what I'm looking at, what's gonna happen now? Sure, that's an expense. Unless I don't think that's is kind of like a 0.001%, fine. But it's got a higher probability, then I have to put into utilizing the equation. Okay. So, but don't do too many of those scenarios because you'll be confused. Scenario one, two, three. I mean, just do the major ones so you have a general idea, and just have some ways of determining the condition that you could do some adjustment. Remember, once you start the strategy, you can still adjust the project, or make it smaller, to make it larger, or to hold off. And the projects are usually designed into stages. Depending on the stage, it should be on your market anticipation or your consumer demand, for lack of better words, to anticipate that. If that's slowing down like it's slowed down with projection, no reason to have a big multinational operation and it's only operating 10%. Maybe I'll find another use for it for somebody else. Okay, multinational corporate budgeting. Oh, we have a lot here. Let me go in here. Okay, not that much. Remember, okay, so this is my summary. Okay, input that will help estimate the initial outlay, periodic cash flows I needed, salvage value, those I need. There's certain information I have to make some even assumptions that I'm doing, and require rate of return on a project. What is the rate of return that the company is looking for, or the stockholders? And that's something most companies, if you're dealing with any kind of capital project, that's the first thing I ask. What's your rate of return? I mean, so I have a general idea. Or when do you think your break-even point, or when do you think this project has to be up and running? Just some variables that you should be out there, okay? Okay, once these factors are estimated, international project net present value can be estimated as if they were a domestic project. Once I have the numbers, it's no different than you're doing in corporate financing that you did in your other course in regular corporate financing domestically. I've got the capital, I'm running a regular project, here's the money, I'm distributing it, because I already had it all converted and everything else into that currency that I'm utilizing it. Okay? Normally more difficult to estimate than an international project. As if, all right, makes it a little easier once I have that down there. Okay, my exchange rate. Create an additional source of uncertainty because they affect the cash flow. Ultimately received by parents as a result of the project. And look at the exchange rate and cash flow. Look at the consumer price index. If the exchange rates change, the consumer price index went up, I got the same amount of dollars, but I could buy less goods. If it went down, devalue, the goods are cheaper, then for the same amount of dollars, because it's stronger, I could buy more goods. So the exchange rate has a good. Remember, I'm bringing in denomination to spend it, and that money that they are utilizing it, because all the currency is an instrument that is acceptable in that geographic area to provide me some kind of a services or tangible goods. Okay. Other international conditions can influence the cash flows ultimately received by the parent. Remember, I talked some about when I can bring the money in, how long got to keep it, you got to reinvest it, what are some of the incentives if you pull out, you got to guarantee labor here, but we'll give you this kind of a break. We'll subsidize your labor for the first five, whatever. All those you have to know include financing agreements, parent versus subsidiary, subsidiary sorry, financing of the project, block funds by the host government when I could bring them back, and host government initiatives. All those have an effect there because I'm not looking at the subsidiary perspective, also looking at the value of, just I get the hiccups now, the value of the added value to the MMC. Okay, so that's it. I think we've done it. Again, we finished another chapter. We're on chapter 14. I think we have one, two, three, four, five, seven more chapters to go, and so it's getting easier. You're beginning to think financial. You're beginning to think international. You're beginning to know hedging. All of this is hedging, hedging, hedging. When do I come in there? Exchange rate. You already know exchange rate, inflation rate, right? What's the exchange? What are forward contracts? Everything you look, all new terminology is making sense now. I know it is. I could tell by in the discussion boards that we're talking in the lecture, you're beginning to pick up a little bit on this. You're beginning to understand it. Remember, the math's there. Uh, I think the last couple of chapters are going to introduce you some software. I won't make you buy the software. I'll let you, play with it a little bit just so you see it. But once the software is there, oh man, this makes my life a lot easier. Okay? Again, so my name is Dr. George Machaki. This is Finance 225, International Finance Management, offered by Harper College in Illinois. You're taking me an online class or face-to-face class, and we've covered Chapter 14, Multinational Capital Budgeting, and we're looking at it from the perspective of multinational corporation, but you could also utilize this for a business that's going into is looking at what do I need to open up a subsidiary, and that's also this going to help you for your major project you're doing. But otherwise, you're doing well. Look, we're past the midpoint. You're coming at the end. It's all coming back together. You're understanding the terminology. You're beginning to use the terminology. Now, you pretty soon you'll have an international finance course that says, hey, I've got some international finance objective. I am not just a domestic. I think locally, but I'm also, I act locally, but I'm also thinking and acting globally at the same time. Again, my name is Dr. George Machaki. Make sure you sign up for this class. Ask me for my name. Hey, what class is Dr. George Machaki teaching?